Citigroup cuts 4,500 jobs and takes up to almost $1 billion in charges for the fourth quarter. Germany, though, successfully borrowing more than 4 billion euros at a low yield, and the European bailout fund will kick off a short-term funding program by the end of the year. All while markets waiting on the edge of their seat for the European Union's two-day summit, hoping for an end to the debt crisis. I'm Alix Steele, and the Morning Call starts right now. Good morning. I'm Alix Steele from The Street, and we have a very special morning call for you today. We have Scott here, as always, with the technical analysis, and we have Stephanie Link, Director of Research for The Street, here with the fundamentals. We're going to break it down for you, the end of the year trading and into 2012. Good morning, guys. Happy Wednesday.
Good morning.
Big Wednesday.
Big Wednesday. All right, so let's get to it. First, I want to start with the technicals.
Hi,
Scott, you know, the S&P has
Hendelman,
really been
CEO
trying to
of
break
T3
out here the
Live.
last couple days. Has this rally mounted to anything? Has it been constructive for you as a trader?
You can look at it two ways. From a macro standpoint, last week we had a huge move. We had that 8% move off the lows, and now we're going sideways. So traders are trying to figure out if we can get an additional move because most of the move has happened overnight.
Right.
So every time you try and buy something, you try and buy it when it's up. By the end of the day, it's down, and then you have to figure out whether or not you want the risk tolerance to take it into the next day. Whereas from a macro view, you know, things look good. The range is getting tight, and it seems like if we can get some good news on Friday or Thursday, Friday into Monday, we could break above the resistance and have some kind of Santa Claus move that would pay people for staying the course.
Stephanie, as a longer-term investor, is that kind of what you're looking at as well?
It's a really big week. You know, you have, you know, the ECB, you have the Bank of England, you rumor speculation that they're going to ease, which they should, right? And there's commentary that they will. You've got this big, you know, the European meeting and a lot of expectations for them to do something. So we have to get through those. And I actually also think that the news out of China is going to be also market moving in terms of
Inflation
PPI,
on Friday,
CPI,
right?
Industrial production, so that they can continue to ease if those numbers are good. That's a big positive to me and a big offset to what's going on in Europe.
So that raises the next question, and we were speaking about this before we got on camera, is what do both of you need to see on Friday in particular from the EU summit or perhaps from China to make you feel better about the market, to really feel like we're going to have some kind of Santa Claus rally into the end of the year?
There is so much that needs to be done there that we need clarity on. I think we just want to see that they're going to agree and no one's really going to fight what needs to be put in place. And I think they're finally talking, besides the monetary union, the fiscal union. So if they could agree to some kind of framework to then ratify what you're saying should happen in March, then maybe the markets could get away from Europe and we could talk technicals, we could go individual stocks, fundamentals, and then we have some room to go before we have to worry or obsess about what's coming out of Europe, but then we also have to watch what's going on in China.
Right, but I would also just say a lot of what's going on here is such a lack of confidence, right? Because we don't know if Europe is going to get their act together, as you mentioned. If they could come to some sort of agreement, you know, if there's, you know, what's the bailout, what's the leverage, you know, what are the numbers out there? I'm not sure the actual numbers themselves are going to be that important, but I think the direction that if they can take in terms of, you know, getting something completed, I think that will be very positive. Again, if you add on some of these other things that are happening, China, better U.S. data and that kind of thing.
So very quickly, does it matter if it's a fiscal consolidation or union thesis we see on Friday, or does it more matter about the bailout fund? Does it more matter about the ECB? Well, it's the one thing they really need to agree on if they have to pick one.
Well, no, I would actually say you have to make steps on all of them, right? I mean, you have to make, and it doesn't have to be this massive home run. It could be a double, you know.
Double would be good.
A double would be
and then
really
we could
good.
steal third base, and then everyone's fine.
We're going to go for this. This analogy will last for a long
It's
time
like
with
a
you.
formula that we need. It's just not one thing. And unfortunately, this whole world, we're looking at so many multiple things. So that's why you have to really know your time frame, know what you're willing to risk, how long you're willing to hold things. And if we take a look at the S&P chart, you know, you'll see how we're constricting and we're ready for something.
All right, so Scott, let's go to the chart because I do want to see what a trader's going to do into the EU summit on Friday.
Okay, so if you take a quick look at the S&P, I'll show you on the SPX. Okay, obviously this was the reversal low, October 4th. You had a fast and furious move up to 1292. A lot of people missed that because it happened so fast. Then you had this wedge right here that wound up resolving to the downside. If you guys remember Thanksgiving week, where traders and long-term investors weren't that thankful, this was the worst week since 1932, you had a stomach buying that. So now we're right back where we were, where traders were looking for a breakout. So we're trying to see if we could hold in here. You have a short-term little range here, above 1240. I think you can have pent-up demand. And if we could finally get above 1260, 1264, the 200-day, with some volume, with some good news this weekend, I think we clear it. First stop 1292, and then going into the first quarter, we could hit 1320 to 1340.
So Scott, does that mean that you're going to be taking stocks long into Friday?
It all depends how we get there. Right now, we're opening up a little bit as a trader. I'd love to see us do it beforehand so you don't have to take so much risk into the weekend. So if we actually broke above 1262, today's Wednesday, and come Thursday on the close, where like at 1285, 1290, I'll feel like I caught some of the trade, and then you keep some on, or maybe have multiple positions with an index hedge, just in case we don't get the outcome and you have to just hold the stocks that you really like.
Now, Stephanie, what about you? I was going to say, what are you doing? I know that you were buying on that dip on Thanksgiving. That was really hard.
It was hard, certainly. So we're not doing a lot this week. We're kind of waiting to see what happens in terms of the news. But I would say this, that if we do get a sell-off, let's just say we don't get what we all want and what we think we need. You know, the companies this week, speaking at conferences, because I've been to a dozen conferences this week, they've said some really good things. Valuations still are very attractive, right? And I think that their projections from what we're hearing from these companies in 2012 is not so bad. So if we get a pullback, we would definitely be a buyer. And if we actually see the market run up, we're positioned there already.
Well, the beauty of what you do also is, like, traders don't like to buy into weakness. So you bought that week, you with a longer term time frame when we were all trying and there was no bounce. If you look back at the chart, you'll see, you know, every single day it was just a bleed lower. A lot of guys got short when we broke this wedge because that was the trade to do, maybe covered into here. And then I know these 2 days is where we're like, okay, this is a spot to buy. This is a Fibonacci retracement. It also coordinates with that broken down trend here. You know, so to buy into this, you don't have to be positioning here. As a trader, you know, that didn't position there, you know, we have to try and figure out if we can catch this next move and be somewhat risk averse.
So let's walk this out for 2012. Let me name some of the risks that we can look at so I can get your outlook. All right, so we have perhaps China slowing 7%, a complete meltdown in the Eurozone, and also a lot of meltdown here in the U.S. in terms of political. I mean, if you look at the S&P, I read some stats that the worst government you can have is a Democratic president and a split Congress in the 4th year of an election cycle. That's exactly what we have. The S&P tends to go lower on that. We also have perhaps the end of the unemployment benefits and the end of the payroll tax cut. Stephanie, what's your outlook?
Well, I mean, you know, a lot can change in 2012, right? So I would just say, at least the way we're positioned is, you know, for a gradual higher market, because U.S., there's a lot of issues politically, but fundamentally, GDP-wise, you're looking at about 2 to 3%, maybe with the bias towards the upside. Just a couple of weeks ago, we were talking about a double-dip recession here, right? Now we're not. So I think that is encouraging, right? And again, I go to these conferences and I listen to these companies and I listen to what they're saying about 2012. Caterpillar just yesterday talking about 10 to 20% sales growth, reiterating that guidance. That's widespread, but it's a great number for a company that, you know, has such exposure globally. I also think, again, China could be the wild card if they continue to aggressively ease. Brazil has just eased for the 3rd time this year. So I think there are offsets, Alex, and I think that, you know, Europe is horrible, but I think we already know they're in a recession. And I think, again, based on valuations, we're pricing in a lot of bad news for the long term.
And lastly, it turns into the tape. Okay, we're in December, and typically strong stocks end stronger because portfolio managers want to mark them up. They want to have the best acting stocks. So
and European investors need somewhere to go. In addition,
So like stocks that have been strong, like we've all talked about, IBM can go higher into the close. Google looks good. Intel looks good. Stocks that have been acting well, they act even better. And then even with the January effect names, like you said at the financial conference, that they all perked up. They have no more tax loss on, so perhaps Goldman Sachs breaks above 102 for another move. Bank of America gets to 6.5. JP Morgan gets to 36. So this is like the trade.
And also consumer, if you listen, TJX is at a new high. Yum Brands raised guidance the other day. So there's some good things that are happening. We just kind of have to settle down and get some answers on Europe to kind of move us, I think, higher.
2 quick things, though. I was reading a note from Societe Generale that said if we don't see an extension of the payroll tax cut, in addition to unemployment benefits, that could shave off as much as 1.5 full percentage points. We also have Bank of America coming out with Merrill Lynch coming out with a note today that puts the U.S. recession risk at 40% for next year. Do you guys think that those overblown, those fears, and we really need to focus elsewhere?
I'm going to focus on the price action because everyone's always going to have something to say. You know, people say this is already priced in. Some people say it's not priced in. It seems like this whole year has been priced in, but every time we get something calamitous, like when Italian yields went above 7 or everything that the market comes in, then we take it in stride, and then the cream rises to the top, and then you take your trades because there's always something to look to make you say, I don't want to be in the stock market, but overall, things are rewarding investors. You know, market participants that actively manage, that know how to buy, that pick the winning stocks, they can make money.
Well, the other thing is, what's interesting to note is that only hedge funds are about 45% net long. That is a really interesting stat. So if we do start to get any kind of momentum over the next couple of weeks, it won't take much to continue to go higher.
All right, fair enough. Okay, we are going to be right back after this. We're going to talk about energy, oil prices, and 5 stocks you're not going to want to miss, so stay with us.
Hi, I'm Sean Hendelman, CEO of T3Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
All right, we want to delve into one sector that we definitely want to highlight. It's energy. So first off, let's get your take on oil prices here. I was speaking to a trader at the NYMEX who's looking for a breakout over 103, if that might happen. We're seeing, if we have sanctions coming on in Iran from the UK. What do you think, Stephanie, long and short term for oil prices?
Okay, long term, I think oil prices can be in a range of about $80 to $100, and I think that's just a function of supply demand. I mean, if you look at the excess supply out there, OPEC has it, but you have declining curves happening in spades, right? So the supply is not as much as people think. Demand, I think, is going to still stay about 1.5% per year growth, largely due to China. Halliburton had a very positive conference a couple of weeks ago saying just that. So I think 80 to 100 is important because at that's a wide level, I know, but the companies can be very profitable and generate a lot of cash flow at those levels.
With that, we're right now at that outlier because we're around 102. So you're saying even if we get above 102 and go to 108,
it's that much more positive.
It's going to be that much more, but it might be short-lived.
Well, I just don't think, I don't think we go, I think 80 to 100 is based on what I see in terms of supply demand. And you think about, Europe slowing, you're thinking about, we're kind of muddling along in the U.S. and China is strong, but they're slowing. So that's why I say 80 to 100 is kind of where I think you can still own energy stocks and still be overweight energy stocks.
And then very quickly, at what level does high oil prices get worrisome?
Caterpillar will tell you above 100. They say the ideal price is about 90. I would say 90 to 100 is what we can handle. I think
just
above
on
that.
The verge.
Yeah,
okay.
I think above that you start to have to worry about the consumer.
Exactly. And then psychologically, I think over 110, that's when everyone will get enamored with it. And that's when everyone will start talking about how could the market go higher with this extra tax on every consumer out there with oil and gasoline.
All right, Scott, let's go to the OIHs because I know it's been something that you've been following, looking at an inverted head and shoulders pattern. Do you see a lot of strength here with that? Yes,
this pattern that's been building for a while is showing you accumulation. It's showing you that people are buying along the bottom. And I love this pattern because we saw it the reverse way earlier in the year. We had a head and shoulders top. We broke 1250. We went down to 1100. It could have saved you a lot of money getting out. So maybe this pattern will get you long. So if you look here at the chart, you'll see this is what I'm talking about. You have the left shoulder. Okay, technicians are funny because everyone says it's like the names that they come up with are so complicated. This looks like a reverse head and shoulders, right? Left shoulder, head, right shoulder. So at this point, if you want to fragment it a little bit, closer, if it starts getting above this area right here of 128, you have a quick room to about 130. And then you have this downtrend that traders might be trading short again. So if we get above this, they get squeezed and they have to chase. And this is when people play for momentum. So if you talk about a measured move in the OIHs, usually it's a distance from the head to the neckline. So right here you have about 100, what is this, about 100 to 130. So if that's the case, next year, the measured move takes you back to the highs of 160, and I'm sure stocks that show relative strength within this group are going to go up percentage-wise a lot more.
All right, so let's get to some stocks you might want to be looking at. So Wells Fargo had a note that says the consensus for next year is about 3.4% earnings growth, and that about 11% of the energy sector sales go to Europe. I wouldn't say that they were bearish or anything on the energy sector, but it was kind of a bummer, considering how high oil prices are. So based on those kind of estimates, Stephanie, what's your favorite energy stock? And do you even agree with those estimates?
Okay, I don't agree with those estimates. I actually think, though, that what's more important, again, is cash flow. Because that's what really drives the investment into this business, right? And if you listen to what some of the companies have said, again, at conferences, they will say you need oil above 80 to have those projects continue. So that's WTI, right, by the way. We're well above that, and that's Brent that they are saying, and we're well above that on the Brent price right now. So I think that you have to focus on everybody focuses on different variables. The cash flow component to me is the most important, and I'm still bullish. And if Scott is right in terms of us seeing a significant potential upside next year, you want to own the higher beta names in energy. You don't necessarily want to own the Exxons or the Conocos, which are great dividend stories. You want to own the companies that have more growth and more leverage to the underlying commodity.
So maybe if you're
Go ahead.
So maybe if like you're risk averse and you want the beta, you could be in like an Exxon, you could be in a COP, you could be in these names because it's a little slower, but more bang for the buck is what you're going to be looking for. So what are some of those names?
Yeah, so, okay, and then within energy, you've got a whole spectrum of types of companies. You can, so, you know, I would say you want to own some integrateds, you want to own oil service, you want to own E&P, you want to own drillers and ENC. And so I think my top pick is Apache, and that is an E&P company. They're the largest company, one of the largest E&P companies in the world. And why I like them so much is they spent $10 billion on acquisitions last year that we're now going to start seeing synergies from this year and next year.
Scott, chart, what do you think?
Here we go. That stock, we've been watching it here and there for good trades, so that sounds good to me. Fundamentally, it might give me more conviction to hold. So if you look here, here's a chart. Okay, you had a big move off that October low. It went all the way back to the old resistance coming in around last summer, and now it's holding higher. You actually have a little bit of a flag pattern here. So for traders, I think if AP, you know, if Apache starts going above 100, people are going to trade it from the short-term level. Then you have this 105 resistance, but once it starts to clear it, I think the first real stop, maybe in 2000, you know, January, February, you have about 111, which is the moving average. And then if the group catches fire and stays, there's no reason why this thing can't get back to 125. So this is entry. You know, if you're in it tier 1 now, above 100 for a tier 2, then see how it handles this moving average, and then it could go higher.
So Stephanie, I know another stock that you like is Enscope. We've talked about that a lot on the street in our videos. Tell us about that one.
Yeah, so this is one of the largest, again, it's kind of in the oil, in the rig market and drillers. And I like this company. It's kind of off the radar screen. Everyone tends to focus on Diamond Offshore and Neighbors and that kind of thing. This company has the second youngest rig fleet. And why that's important is because their products and their fleets make their customers more efficient. They have high technology on these fleets that actually really help drive growth for their customers. And I think that the Pride acquisition that they've made last year will be very synergistic. Again, it's something internal that's happening at the company, so they'll kind of have a double whammy in terms of on the positives. They'll benefit from higher oil prices, but then also from the synergies from these acquisitions.
Scott, I want to go to the chart. Take it away.
Yeah. Here you go. I'll just go right to it. If you take a quick look here, this came a long way. This was so battered and bruised. I guess no one really understood those acquisitions or whatnot. He was at reversal, which was hard to see, but then you had a quick move, just like the last one we saw, Apache, right back to resistance. So you normally have a pullback. It held the moving averages. It's above the moving averages. It's getting tight here. Traders, in my opinion, or even for me, I would start buying this above 52. And then once it clears 54, you know, it's got a clear sailing all the way back to those old highs, and those old highs are around 60. And if you take a quick look at the weekly chart, you will see that, you know, this stock really has nothing to the left. So to me, that's even more exciting because, you know, you could probably even go to 75 if everything works out.
Now that's one of the, you know, we were saying under the radar stocks, but Schlumberger is also a stock you like, Stephanie. That's very much on the radar, the biggest oil services stock out there. Is the story played out at all?
No, it's still down from 94, their high, and I think that the stock trading at a 10-year discount to its historical average on a valuation basis. This company, I like deep water. Ensco also is deep water. Deep water markets are tightening. We're hearing better contract prices and longer contract time. So the contracts are now lengthening, which is a very big deal. And we haven't seen that in several years. So these guys have the broadest product set. They've got the best management team, great technology, excellent customers. And I think, again, the valuation still makes sense here.
Scott, do you agree? Do you think it's a good trade setup here?
Well, it's good to hear the story behind the stock because I talk about Schlumberger also, and I just call it SLB. You know, so it makes sense now when you look at it. So if you look at the chart here, you'll see that this too has somewhat of an inverted head and shoulders. Here's the left shoulder, here's the head, here's the right shoulder. Wow. It's already trying to break above the resistance where you saw the other two stocks weren't even trying yet. So this is showing relative strength. I think the first stop here could be the moving average around 80, but there's no reason why this can't make it back to highs also to 95 and then some if the market stays intact for next year, which it looks like it will.
Two stocks. Let's see if we can do it in 2 minutes. All right, let's go to Hess, talking about integrateds you wanted to own. Stephanie, why don't you pick Hess over, say, the Exxon and Chevron? That's sort of a little safer.
But again, because it has more beta to it, it's the highest correlated to the underlying oil price. If you think oil prices are going to go high or even stay high, this company's going to print money.
Scott, what do you think?
Okay, let's take a look at the chart.
As a chart, would you be looking at Hess first or an Exxon? Because we talk about Exxon more.
Because sometimes it's easier with patterns, and patterns make movement easier for traders. So if you look here at Hess, you'll see two different patterns here. This had a nice move off the lows, came in. It doesn't have like a level to trade through. Right now it is holding higher. It's above the moving averages. I would say above this 61.84, you'll have a move to this resistance around 65 and then the moving average. And once it does clear this, there's really nothing up until this area. But the difference between XOM is that there was a downtrend that people were shorting versus. So to downtrends break, to me it's exciting because it's a point of reference. So you have a high, lower high, another lower high, and it's getting above it. So here's a nice trade, and the longer we go sideways, the easier we have a move to 84 and back to the high. So it's just a different pattern. This was the last time we talked about XOM, if you remember on the show, Alex, right around 74. Quick move to the downtrend, retested that area, and now it's trying to puncture through. So as long as it holds higher here, I think the path of least resistance to the upside, and I'm sure something with a higher beta like Hess will follow suit and maybe even start leading versus lagging.
Yeah, I think a lot of people have been hiding also, by the way, in the dividend stocks like an Exxon, like a Chevron, like a Conoco. So it makes me a little nervous, though, because it seems to be a crowded trade, to me.
It's good, so off the beaten path.
And the last stock we want to hit on very quickly is going to be Fluor. Stephanie, you like this as an oil play. Explain to us why.
Yeah, it's an engineering and construction company, so people wouldn't necessarily associate it with energy, but 60% of their business combined with backlog is oil and gas projects. So they're building projects around the world for the oil companies. And we just talked about the oil companies are very cash rich, they're very strong, the projects are going to continue to be announced, and that's a beneficiary to Fluor. Fluor is the largest company in the world in this particular industry, and it's trading also, again, at a 10-year discount to its historical average.
Scott, what does the chart tell you? Is this a stock you would want to be interested in?
I don't really look at it that often.
Yeah.
I just put it up, and it looks very interesting now because I see 2 price points that I might be excited about. So take a look here. You'll see first another inverted head and shoulders pattern, but you have 2 pivots. This is one right around about 56.40, and then I just talked to you about downtrends that we love to trade through if they break, and here it is. So there's another level coming up to about 57. So this would be buy area 1. Probably will pause at this mini downtrend, and then if it can go sideways and get through it, that's another trade to take it probably to 62, which would be a spot to take some off. But then once it breaks this downtrend, you have the movement and you have the freedom to keep moving higher if this group stays in vogue. And fundamentally, it seems like it will.
All right, well, that's it for us for today. Stephanie, I want to thank you so much for joining us. It was a lot of fun to get a really good fundamental and then technical analysis of energy and the stock market. So thank you, guys.
Thank you.
Thanks for being here.
All right.
Something different.
It's something different. we like different. All right, well, happy Wednesday, everybody. Happy trading. I'm Alix Steele from The Street.